Hey everybody, Noah Davidson here. Just wanted to walk you through a quick trade adjustment idea. I'm in a virtual account working on an iron condor trade, and what I've got here is a iron condor on the Russell 2000 index, and the Russell's gotten pretty directional since I put the trade on. So I threw the trade on last week when the market was down here around 1500. We had a pretty good clip, a pretty good distance out there to the strike price and down there to the strike price. So those are the break-even points that I've got plotted on the chart. And as long as the index stays in the middle, it's going to be in good shape. But with the market running like that, and this is a pretty good little position size I've got set up here, you'll actually see that I've got the 20 by 20 contract there, and the drawdown starting to feel a little bit of pain. These are some of the issues that we're facing. Is the delta's gotten very negative, and an iron condor is supposed to be a neutral trade, so it's getting really directional. The time decay is working for us, and that'll work over time as long as it stays in that range. But when you start to feel that kind of a drawdown in the account, again, this is a big position size, 20 contracts, and most of you won't be doing that. But it's a big position size, and whenever I don't care what your position size is, but your pain threshold starts to you feel that, and so that makes you worry about the trade. And even though in theory, the stock price right now is trading inside the iron condor here, it's getting to the point where where people start to stress and worry about it. And we're starting to ride that purple slope and starting to feel the drawdown. Now, if we break it down and look at these individually, the put side, let's take a look at the puts. The 1300 by 1290 put options are pretty close to maximum gain, and they're not really helping us anymore. They actually have kind of made maximum profit. So what I've done is I've set it up where we're going to try to roll it up to 1430 by 1440, and when we do that, I've got a little virtual order down here to show you that. We're going to keep it in the same month. We're simply going to buy back the lower strike price, the 1300, and sell back the 1290. And we're going to roll that up to new strike prices, 1440 and 1430. Now, that's based off of a couple things. One, there's a support zone here at 1450, so I'm rolling it up from down here, 1300, up under support to bring in some new money. And then two, it's based off of delta. If you go look at what the delta is, the general rule on a condor is the delta is going to be 10 or less. And so as we look at the existing positions, clear down there at 1300, and that delta's dropped to 2, and so we can afford to roll that up, clear up towards 10 or so. I'm usually around 7 or so on those. So here's the 1450 strike, and that's a delta of 9. So the 1440 puts us at a delta of about 8. So that, again, gives us a high probability of it still expiring out of the money. We're basically just going to split that spread between 1430 and 1440. So as we take a look at that, what's going to happen here is we roll that leg up. That brings in new money. That brings in a nice little credit right there. I believe the credit's around 32 cents. So 32 cents, that's $32 a contract. So that's $640 of new money. And that's actually going to take your maximum profit and push it up. And it's going to neutralize the trade a little bit. So this is kind of the current delta. Let me show you that. Those puts are only providing a delta of 2. And so when we roll it up, now we've got a new delta of 15. And that's just the put side. We throw those calls back in the equation. And that negative 92, when we roll that up, we dropped it down to 80. That reduces the delta a little bit. It increased the theta a little bit. And that, again, it narrows that condor up, but it puts some money in our pocket right now. Okay, now that takes care of rolling up the bottom. So I'm going to go ahead and we can submit that order, see how long it takes to get filled. That may take a moment to get filled. Okay, and then the next step, and while we're waiting for that to get filled, let me analyze that, throw it back into the trade so we can look at it. Then we have to worry about, well, what if it keeps running? What if the stock keeps running up? What if the index keeps rising and it's getting closer and closer to that break-even point where, up here we were sad because we end up losing a lot of money. So we want to make sure that that doesn't happen. You can start breaking legs just a little bit. And so here's an order. Here's the short call, 1640 call. Okay, and we can start buying those back, and you can start buying them back, one at a time or so, and see what that does to the trade. So if I buy back one, a couple of things happen. One, you'll notice the delta, we drop the delta down significantly. And that's kind of part of the key is it starts changing our delta because we start to see that the condor is a little unbalanced. If we go with 2, you'll notice the delta, we drop it to negative 27. That purple line starts to get flat. Now that's taking some losses on the short calls, but if the stock continues to rise, we'll eventually break even. Now, it depends on, again, what your directional bias is and how far you think it's going to run. If we buy back enough contracts, maybe 4 or 5, the break-even point's going to end up dropping down to a point where if it continues to rise, we'll actually be able to walk away from the trade without too much damage. So if we end up buying back, 3 contracts puts our break-even point at about 1675, which means that if it, that means it wouldn't break even until it got out here. You'd have to see the candles continue to rise clear out here to break even on that. This is again, breaking a leg. You could add other option contracts, buy calls. Again, you can also hedge this with the futures contract. But if we were to look at, again, analyzing that and buying that back, and we probably need to make sure we actually are splitting the spread on that better. So let me go hit confirm and send and double check what we can get the spread on that for. 1070, that makes a bit of a difference on that. Okay, so again, 1070 on that. Okay, got that back in there. And if we do that, that is right there, 4 contracts, price of 1070. That kind of puts the whole condor there. Just you have a small expense on that, but then if it continues to rise, by the time it gets out to about 1644, you shift from negative to positive. You'll see that trade break even. So again, 1644 about right where that current break even point is. And if that continues to run, takes out resistance, that's assuming you bought it back right now, it starts to hedge that out. And that's not a bad way to approach the trade management, just taking off some of the legs. Or you could add on additional legs if you wanted to get a different hedge, which means you're buying call options. And again, the idea is we want to try to balance that out. Now, I typically don't run out and throw those on a Friday. And I probably watch this market today because it's already range up, ATR up. Doesn't mean it can't go more. It should mean my expectation is that it does not. But if come next week, I'm thinking that the market's still got some legs behind it, and I'm worried about that condor. We've already rolled the put side up. That's working for us. That's helping us out. And then if we need to, we start buying back a few. Maybe start out buying 2 of those back, and just changing the landscape there, so that if it continues to rise, that we don't sit and draw the account down more and more. It kind of keeps the pain threshold down and allows you to ride that out. And again, the trade adjustment on that, the biggest risk is that once you change the trade and you break the legs, you're becoming more directional, and you're going from being a neutral, trade where you're trying to roll it up into a direction or buy those legs back, breaking the legs. We could roll the call side up too if we wanted to, and reduce some of our risk there. And again, I probably would worry about that, if it continues to rise and starts taking out that resistance point. Hopefully this has been helpful for you to kind of think through some of the trade management on your iron condors, and we'll see you in the next video.